Hello and welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. Will the market go up? Will it go down? And how to manage my portfolio during this volatility? Now, that's a question that's bound to have crossed our viewers' minds in the recent market turbulence. So this week, we've decided to put the spotlight on a relatively new investment avenue. We're talking about structured products, a slightly advanced investment concept that promises to enhance portfolio returns. And to help us navigate through it, we have with us Feroze Azeez of Anand Rathi Private Wealth Management, who's joining us on the show today. Feroze, thank you so much for taking out the time. It's good to have you on. Now, the term structured products, I think, was became a little familiar to the Indian market back in 2005-06, if I'm not mistaken. That's where we started, kind of dabbling in this concept. But for those who've been left untouched, let's start with the basics. What is a structured product?
See, structured products, but the nomenclature looks a little more complicated, but it's actually a very simple concept. When you buy a bond from a corporate, the returns of that bond are generally fixed as 8, 9, 10, 12%, depending on the company who is issuing the bond. Unlike those bonds, these are nothing but bonds whose returns are not fixed, but they are market linked.
Okay.
For example, they say at these levels of the market, this is the return you're going to get. You might get a 2% return or even an 18% return. The dependency on of the return would no more be a fixed number like 8, 10, 12%, but it's going to be market dependent. So it's a very, very good method to navigate the markets, like you were just saying. In the short run, when the volatility is there and it becomes very difficult to live through the volatility to see the benefit of the long term, this actually brings in some degree of stability to the portfolio because it gives you a 2-year, 3-year perspective on the market and is actually an inherent debt instrument with a flavor of equity.
So it's basically a bond that's wrapped with an additional instrument, thereby giving it that scope of the enhanced return. What is that additional instrument? Are we talking derivatives here?
Correct. Yeah, there is some degree of a smaller degree, a significantly smaller degree of derivative combined with debt to give you the similar payoff of saying that markets would go up, let's assume 10%, you will make 15%. So it gives you a multiple on the market. To answer your question, yes. Derivatives, long-dated derivatives, not the 1, 2, 3 month derivatives, long-dated derivatives.
How long when you say long? Because, the reason I'm asking this is that derivatives became a universally hated or bad word, after the 2008 subprime crisis. So therefore, for viewers who might be a little circumspect about getting into a product that seems a little complex, when you say long-dated derivatives, how would that be different from, a shorter-term security?
Derivatives can be used for several purposes. Like you absolutely rightly pointed out, people became a little circumspect after 2008, where there was a large attribution of this whole crisis to derivative being mismanaged.
Yeah.
So derivative can actually be used for hedging, speculation, or extreme speculation, leverage and stuff. But if you mix derivative in a very small quantity, it becomes a very good instrument to create a payoff. Now coming back to the point of how long-term, 2-3 year derivatives, which is little known, that NSE has 1, 2, 3 month derivatives which a normal broker actually highlights to his client, but there are on NSE derivatives which are 1, 2, 3 and up to 5 years which are there. Generally institutions deal in it, and then you combine it with debt, can give you a payoff which a normal investor is not able to replicate. So that's a structured product in a nutshell.
So then let's get some more hygiene elements out of the way. I understand that the market size of this product is around 10,000 crore rupees right now. But how liquid is this market? Who all is trading into them? And who's regulating this market? So as an investor, I want to be absolutely sure that this is, a very liquid and very well-regulated market that I'm entering.
See, absolutely. Since the derivative is just a secret of what it goes in, the client actually does not have to be very concerned on the liquidity of the underlying derivative. It's a bond. Okay, so these bonds sometimes are listed, sometimes are not listed on the exchange. If they're listed or unlisted, the issuer generally buys them back. From a client's perspective who has bought a 3-year structured product, but after 1.5 years wants to unwind it or make good his investment and take the money back, the issuer of the bond, like the corporate which is issuing you the bond, will generally buy it back. So liquidity is extensively there from a perspective of a buyback. Just like in mutual fund units, when you go to sell your mutual fund units, the mutual fund company buys them back and you actually don't have to find a buyer for the mutual fund units. Similarly, the issuer finds a price and gives you a price and buys that back from you. So liquidity is reasonably good. The other very important aspect which you rightly pointed out is regulation. So regulation is a very good mechanism for an investor to derive comfort out of, saying that is this one instrument I can participate in. So if you look at regulation, these NBFCs, which are the issuers of these bonds, are regulated by RBI. So RBI extensively regulates any issuance and money collection by these NBFCs. So it is in effect regulated by RBI.
And NBFCs, like, if you could give some examples of the actual issuers of these bonds?
Yeah, so NBFCs, there are a couple of MNC, multinational NBFCs, like Citi and Deutsche and all these companies. In the Indian fraternity, you have Reliance, Edelweiss, Anand Rathi is one of the largest issuers. So these are the few issuers, NBFCs, and they're regulated by RBI. But when it comes to listed debentures, then SEBI also steps in because it's listed. So these are the regulations. So it's very well regulated kind of mechanism.
Okay, absolutely. So just talking a little more about now the nature of the product. Is this a customized product that is, a structure is created per client as per his need, or is it like going to the mall with some pre-designed sizes, either a medium, small or large, and you figure out what you fit into? So how are these structures created, and what is the threshold of investing in them?
Threshold is generally on the higher side. Like you said, it is for more sophisticated HNI kind of a community. So 25 lakhs is the minimum amount which is invested in these debentures.
Okay.
Now coming to
that's a RBI mandated or SEBI mandated threshold.
Absolutely.
I'm guessing.
It's a RBI mandated threshold. The 25 lakhs becomes the minimum to make sure that the end user of these debentures has a clear understanding of what he is getting into. Thresholds generally become regulators' good mechanism to filter out people who might not be able to interpret what they're getting into. So coming back to whether it's customized or it's tailor-made or it is one size fits all, it is somewhere in the middle. So like a mutual fund can't be customized at all. Here a structured product can be customized. You will have a smaller group of people who would be like-minded who will participate. But there are some very large investors, which is far and few between, who say this is exactly what I want and I don't mind putting in a couple of crores to get that degree of customization. So it is somewhere between a mutual fund to something which is a PMS, which is completely customized on the equity category. So it is, I would say, on a scale of 1 to 10, it would fall 5, 6 on customization, where mutual fund falls 1 on customization.
Okay, fair enough. Well, we've only gotten started on structured products. We're going to take a quick break, and on the other side, get down to understanding the different types of structured products. And then the million-dollar question, or the 25 lakh rupee question, why should you use structured products anyway? How do they compare with certain other instruments? All that after a break. Welcome back. Here with Money, 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 and we are talking about structured products this week. So Feroze has already told us what these products are like and the fact that they are for HNIs and the threshold is about 25 lakh rupees. Now let me get down to the different types of structured products. And Feroze, you've told me in our earlier conversation that they are a mix of debt and equity, and then a mix in terms of the risk appetite as well, whether they're an aggressive structured product geared more towards equity or a relatively conservative which is geared more towards debt. Do elaborate this for us and how this is all structured.
So structured products, like you rightly mentioned, in terms of the risk they take, the market risk they take, they can be categorized as equity kind or debt kind. So if they are debt kind, they need to be principal protected. They have to make sure that under any circumstance of the market, your principal should be protected. These become instruments which come very handy during uncertain times where you don't know directionally where the market is headed, and that fear factor keeps you away and keeps you waiting on the sideline. So principal protected and non-principal protected. The principal protected would be more debt-like, and the non-principal protected will be more like the equity types. So these are the two basic classifications. On the debt category, which are conservative, there are some structured products which also assure you a minimum return. Like a 5%, 6% minimum, and then a market upside. So those are all debt category, and the ones which actually risk your return and also your capital, which are the non-principal protected ones, are actually the equity category. So these are the two basic categories which people use in trying to create a portfolio alongside mutual funds with structured products.
That's exactly what I was coming to. What would be the need to invest through these products? I mean, if you're just looking at adding a little bit of debt and mixing it with some equity as well, you could do that through direct avenues of either direct equity exposure or mutual fund exposure. And of course, there are different debt avenues. So then why would you go for these? Or is this an add-on that you would advise?
No, I think it's a very, very important question. Like you said, if it is me too, why would I actually add it to the portfolio? One is non-principal protected market participation doesn't exist. So if you want to actually participate in the market, you have a direct equity which will lose you money if the markets take a U-turn. So will the mutual funds in most likely situations. So all instruments, PMS, mutual fund and direct equity have a tendency to lose money for you when markets take a U-turn and if markets fall 20% due to any unforeseen circumstances. But a principal protected structure product can protect your capital and help you navigate through these volatile times. That's one purpose. So trying to clearly eliminate yourself from market downsides is one. The second thing is structured products can give you a compressed return. What do I mean by that is, if the market goes up, there are structured products which tell you that if the market goes up 10-12%, in 3-year periods will give you 80% return. For example, one of the products which we have been giving to our clients is that if the market goes up 10% in 3 years, cumulatively, which is a minuscule 3% an annum, you will make a return of 80%.
And this is going to be a product which will obviously have a greater equity exposure. So it's a more aggressive structured product.
Absolutely. And on the contrary, if the market goes down 10%, you will lose 10%. So it can't be categorized.
But the downside is not protected here. There's no capped.
In this one, it's not protected, is why they're categorized as non-principal protected equity-like. So see, what happens is if you're going to get 80% return in about 3.5 years with a 10% growth on Nifty, then you don't have to worry that there is a large probability that the market will at least bounce back to 8,300 levels if you're sitting today. So this becomes a very good parallel thing, complementing the mutual fund. It is not contrary, it is actually complementing. See, for the mutual funds to deliver 80%, markets will have to go up 50-60%, but the structured product in 10% growth will give you 80%. So two purposes: protect your portfolio or compress your returns in the first few percent. These are the two basic reasons.
On that note, let me quickly come back to some of the other issues relating to this. What are the other risks that an investor must keep in mind?
See, of course, there are two primary risks. One is, are you okay with the return which the structured product is promising in different market situations? That's the market risk. Okay, if the market goes up X, how much do I get? So you generally, a structured product shows you a graph to give you a simulation at different levels of market what happens. So you need to be very, very comfortable that if the market goes down 20, are you comfortable losing 20? If you're not, then you have to change your product. So one is market risk. The other primary large risk, and the rest of the subset risks are a different story, is the issuer's credibility to repay you the money at the end. Just like when you buy a bond, you see his rating, or maybe you see the credentials, the balance sheet and stuff. If the corporate is managing the money properly, there is a large propensity that he will not default. So these are the two risks. One is the credit risk, one is the market risk. The good part is the credit risk is very well mitigated by having a trustee. These are secured debentures. Unlike a bank fixed deposit, there is no trustee. Here there is a trustee who actually, now for example, Anand Rathi's trustee is one of the largest trustees in the country who acts like a custodian to collateral in the favor of the bondholder. So to summarize, two major risks, I will not go into the sub ones. One is the market risk, the other is the credit risk. Credit risk is an important risk which gets eliminated, but because of its secured nature, and the issuer gives collateral to the trustee.
But are all structured products secure, or again that will depend on which product you're using?
99.99% of the structured products are secured in nature, and especially the ones which Anand Rathi has issued, all of them are. So they could be unsecured, but 99% of them are secured.
Now, another basic question. My understanding is that these products are more design driven. They're not so much manager driven. It's not like a mutual fund where every 10 days or 15 days you see the market and there might be a tweaking of the portfolio or tweaking of the, the fund choices as such. That might be a good thing. I mean, it's less human intervention, but what if the market stops behaving in the manner in which you had forecast, and then therefore are these products therefore less flexible? And during the tenure, what happens if the market performance is not as what you had anticipated?
Absolutely. Actually, you've hit the nail on the head. The difference is, in a mutual fund, there's human intervention. Here, there's no human intervention. If somebody's got 100 rupees, okay, making sure 30 rupees is mechanically managed with no emotions anyone's, for example, fund managers or yours. It is just mechanically managed. Here there's manual management. Of course, there are flip sides of mechanical management, but if you're looking at a mediocre market performance of about 8-10% in 3 cumulative years, you'll at least get 1 year which will give you those 8-10% at least. So you reduce your expectation from the market to mitigate this risk of wanting to change your opinion in every few months. So yeah, large portion of your money should be human intervened, and some portion of money, which is 25-30%, should be mechanically